Have you ever wondered where to pull money from first in retirement if your goal is to optimize your taxes? Or maybe how to effectively manage your income in retirement while reducing that tax liability? Imagine this. You've worked hard your whole life. You've saved diligently, and now you're finally ready to enjoy your golden years. But as you start withdrawing from your various retirement accounts, you're hit with a nasty surprise. A hefty tax bill that eats away at your hard-earned nest egg. Listen, don't let this happen to you. In today's episode, I'll share strategies that can help you keep more of your money where it belongs, right there in your pocket. Stay tuned because today we're diving deep into these crucial questions that could save you thousands of dollars in retirement. Before we get into today's topic, let me quickly remind you about yesterday's show. Yesterday, we discussed essential money management tips for individuals and business owners. If you missed it or want to revisit any of our previous episodes, remember, you can find them all at AskRalph.com. Now let's get to today's topic. I received a message from Bridget. She's a longtime listener who's approaching retirement. She wrote this: Dear Ralph, I'm turning 65 next year and I'm planning to retire. I've been diligent about saving and have money in my 401k, my Roth IRA, and I have some regular investment accounts. But now I'm confused about where to start withdrawing from. How do I do this in a way that minimizes my taxes? I don't want to make mistakes that could cost me thousands. Can you help me understand the best approach? Well, Bridget, thank you for this excellent question. It's one that many people approaching retirement age grapple with, and I'm glad you're thinking about it now rather than after you started withdrawing funds. Listen, I'm a few years away from starting retirement, but trust me, I get this question several times a week in my practice, and I unfortunately got some horror stories about when people didn't plan this well, and it cost them huge chunks of savings they worked so hard to create. Well, let me share that with you today. Welcome to the Ask Ralph Show, where we master your finances from a Christian perspective. I'm your host, Ralph Estep Jr., and I'm thrilled you joined me today for another Tax Talk Thursday. Whether you're driving to work, doing chores around the house, or taking a walk, I truly appreciate you taking time to tune in and invest in your financial future. Before we dive into today's topic, let's start with a powerful word from Scripture. It's coming from the book of Proverbs, chapter 13, verse 11. It says this: Dishonest money dwindles away, but whoever gathers money little by little makes it grow. I love that verse. And Bridget, you've done the hard work. You've put aside that money little by little. This verse speaks directly to your topic today. It reminds us that patient, careful money management of our resources, including how we handle our money in retirement, can lead to lasting financial stability. The verse also emphasizes the importance of integrity in our financial dealings, which aligns perfectly with our goal of optimizing our retirement withdrawals in a legal and ethical manner. The truth is, this verse sets the stage nicely for our discussion on tax-efficient retirement strategies. It underscores the value of the little-by-little approach we'll be taking about carefully planning our withdrawals to minimize tax impact over time rather than making those hasty decisions that could deplete our hard-earned savings quickly. Well, now let's address Bridget's question about where to pull money from first in retirement to optimize taxes. Now listen, this is a complex topic, but I'm going to break it down into manageable pieces and provide some strategies that can help you manage your retirement income while at the same time reducing your tax liability. First of all, it's important to understand that different types of retirement accounts are taxed differently. Traditional 401ks and IRAs are what they call tax deferred, meaning you'll pay taxes on them when you take the money out. Roth IRAs, on the other hand, are funded with after-tax dollars, so qualified withdrawals are tax-free. And then really the final thing here, what we call taxable investment accounts, are subject to capital gains taxes when you sell investments at a profit. So Bridget, with that in mind, here are some strategies to consider. Number one, you got to start with your required minimum distributions, or what we call RMDs. If you're 73 or older, now that's the age as of 2024, you're required to take a minimum distributions from traditional IRAs and 401ks. These RMDs are mandated by the IRS, and failing to take them results in hefty penalties. You don't want to mess this up. So if you're at the RMD age, start here. You should sit down with your investment advisor and get a clear understanding of your RMD obligations so you have a plan set up before you get started. Number two, tap those taxable accounts next. After taking care of RMDs, consider withdrawing from your taxable accounts. These are your investments with after-tax money instead of those pre-tax money investments. This is where you're going to have your long-term capital gains, and are typically taxed at a lower rate than ordinary income, so this can be more tax efficient than withdrawing from a traditional IRA or 401k. This strategy may reduce your overall tax burden. Listen, I got a real story here. I got a client. She right now is sort of retiring early. She's backing down on it. She's still working, but not working full time. And what she's doing to subsidize her income is she's using these accounts to pay on the capital gain so she doesn't have to pay that big tax burden. Let's move on to number 3. And that's use traditional IRAs and 401ks to fill up lower tax brackets. I'm going to talk about that right now. So if you've exhausted your RMDs and exhausted your taxable accounts, or if you need more income than those accounts have, you could consider withdrawing your traditional IRA or 401k up to the top of your current tax bracket. This strategy, known as bracket filling, can help you control your tax liability. Now listen, this is where you truly need to enlist the services of a tax pro to help you understand the sweet spots in the tax code to minimize your tax burden. I can offer you effective tax planning to set up a successful strategy. If you're in that situation, do yourself a favor and schedule a consultation with me. Just go to AskRalphPodcast.com/store and schedule a meeting with me right now, and I will get you going on the right path. This is an area where a mistake can truly cost you a fortune. Well, let's get back into our list. Number 4, save Roth accounts for last. Since qualified Roth withdrawals are tax-free, it's often best to let these accounts grow as long as possible. They can be a valuable source of tax-free income later in retirement when your other accounts may be depleted. Again, this will be part of an overall tax strategy. And finally, number 5, consider Roth conversions in low-income years. If you have years where your income is lower, maybe you took an early retirement before you started Social Security, consider converting some of your traditional IRA to a Roth IRA. Now, you're going to pay taxes on the conversion, but it's going to be at a lower rate because of the fact you have less income, and those future withdrawals will be tax-free. I did a show about this very topic a few weeks back, so I'm going to encourage you to check it out. Again, all of our shows are in the archive right at AskRalph.com. Just click on search, and you'll find over 400 past shows on all sorts of financial topics to help you manage your finances. Now, let me tell you another personal story. I had a client who sold their business at a huge loss. We worked with her, and she did a ton of these IRA to Roth conversions, and it's going to save her a ton of money as she takes that money in retirement. Now, let me share a personal experience that illustrates the importance of this strategy. A few years ago, I had a client. Let's call him John. He came to me frustrated because he was paying much more in taxes during retirement than he had even anticipated. When we looked at his withdrawal strategy, we found that he was taking large distributions from his traditional IRA. That was pushing him into a higher tax bracket. It was not a good plan. So we sat down together. We adjusted his strategy. We started with his RMDs, then tapped into his taxable accounts and carefully managed his traditional IRA withdrawals to stay within his desired tax bracket. We also did a few Roth conversions in years when his income was lower. What was the result? Well, here's the best part. John's tax bill decreased significantly. That left him with more money to enjoy in his retirement. It also allowed his money to grow since he didn't have to take as much out to cover the taxes. Think about it like this. The less taxes you have to pay, the less money you need to take out, and the more it can grow and continue to grow and provide for your retirement. Remember this. Everyone's situation is unique, and these strategies may need to be adjusted based on your specific circumstances. You got to think about things like age, your health, other income sources like Social Security or pensions, and your overall financial goals. All of these things play a role in determining the best withdrawal strategy for you. So, Bridget, here are some actionable steps you can take right away. Number 1, take an inventory of all your retirement accounts and understand how each is taxed. It's important that you understand that. Number 2, estimate your retirement expenses and income needs. Yup, Ralph's talking about creating a budget, or as a friend just called it that I interviewed, we're going to develop an intentional spending plan. I love that way of saying it. Number 3, consider working with a financial advisor or tax professional to create a personalized withdrawal strategy. Schedule a consultation with me today if you're in this situation. I can help you. Number 4, stay informed about tax law changes that could affect your retirement income. These things do change. For example, the strategy on RMDs changes sometimes. Number 5, Review and adjust your strategy regularly as your needs and tax situations may change over time. You can't just set it and forget it. So to recap, optimizing your retirement withdrawals for tax efficiency involves understanding the tax implications of the different account types you have. We got to talk about strategically ordering your withdrawals and potentially using techniques like bracket filling that we talked about and maybe doing some Roth conversions. But by planning carefully, you can potentially save thousands in taxes over the course of your retirement. Well, thank you for tuning in to today's episode of the Ask Ralph Show. I hope you find this information helpful as you plan for a financially secure retirement. Remember this, good stewardship of our resources isn't just about accumulating wealth, but also about managing it wisely so we can live generously and fulfill God's purpose for our lives. Now be sure to join me tomorrow when we'll be discussing what are the top financial tips for transitioning into retirement. It's a perfect follow-up to today's topic, and I'm going to provide even more valuable insights as you prepare for this important life transition. Well, if you found today's episode helpful, I'm going to encourage you to visit our website. That's at askralph.com. There you can join our community and get access to additional resources. And here's something exciting. When you join our email list, you'll receive a free copy of my book, Mastering Your Finances. Now, this book normally sells for $10 on Amazon, but it's yours absolutely free when you join our community. And listen, big favor to ask here. Don't forget to share this episode with friends or family members who might be approaching retirement, or maybe they're already in retirement. Your share could help someone avoid some costly tax mistakes in their golden years. And if you'd like personalized help with your retirement planning or any other financial matters, I'd be honored to assist you. You can schedule an appointment with me by going to askralphpodcast.com/store. And lastly, I want to remind you that this show is all about answering your questions. So if you've got a financial question you'd like me to address on this show, send it to me. You can send it to my email. That's ralph@askralph.com. Or if you prefer, visit our website. Again, that's askralph.com and click on the microphone icon at the bottom of the page and you can record your message. Your question just might be featured on a future episode. Well, thanks again for listening. Remember, my passion is to help you achieve financial success. My passion is to help you live out your dreams and grow in your faith. So as I always say, until next time, stay financially savvy and God bless you abundantly.
Thank you for joining us on the Ask Ralph podcast. And with a simple click to subscribe, we'll invite you back to our next episode. And remember, financial issues don't have to be complicated. Just ask Ralph. The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media, Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.